Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of strategies to minimize reinvestment risk in your portfolio. Sensitivity analysis. Sensitivity analysis is akin to stress testing your investment portfolio. It evaluates how different scenarios might affect returns, giving investors a clearer picture of potential reinvestment pitfalls. This is your tool for peeling back the curtain on how various factors might influence your returns. Here's how it works. Scenario building. Think like a chess player, anticipating different market movements. By modeling various economic scenarios, you can assess how your investments could fare under different conditions. Would your portfolio waver if interest rates plummeted? Or rise unscathed? Variable testing. Change one factor while keeping others constant. See how altering interest rates, economic growth, or inflation impacts your portfolio. It's like tuning a guitar. Adjust one string at a time to find the perfect harmony. Outcome measurement. Track how slight adjustments affect your investment outcomes. It's about moving from guessing to knowing. With clear metrics in hand, reinvestment risk becomes less shadowy and more manageable. By using these techniques, investors can craft a strategy that anticipates shifts, minimizing reinvestment risk's grip on their financial future. Mitigating reinvestment risk. Reinvestment risk is the silent player in the game of investments. We all know it's there, lurking at every decision point. The question is, how do we handle it? Key strategies can act like a shield, protecting your portfolio from its grips. Let's look at 2 approaches: diversifying your investments and using financial instruments effectively. Diversification of investments. Diversification is like having a safety net. When you spread investments across different assets, you lessen the chance that all follow the same losing path. Why put all your eggs in one basket when a little variety could shield you from loss? Variety counts. Mix up the types of assets. Stocks, bonds, real estate, they each react differently to economic changes. So when one dips, another might soar. This balance can help keep returns steady even when reinvestment opportunities shift. Geographical spread. Think beyond your borders. Including international investments might protect you from local economic downturns. Developed markets and emerging economies can provide different returns at different times. Asset classes. Diversify within asset classes. Even among bonds, short-term, long-term, corporate, and government bonds offer a range of reinvestment opportunities and risks. This diversity helps cushion against any single sector's downfall. Think of your portfolio as a garden. A variety of plants can survive different weather conditions, ensuring a thriving collection even when some struggle. Diversification works the same way, fostering growth through changing climates. Use of financial instruments. Financial instruments are your toolkit for managing reinvestment risk. Using the right tools at the right time can save a project and your investments. Bond ladders. This is like having a series of safety nets. By staggering bond maturities over several years, you lessen reinvestment risk because not all cash becomes available at the same time. As each bond matures, you can reinvest in new bonds at prevailing rates. Annuities. Consider integrating annuities for steady income flow. They can provide fixed payouts over time, sheltering you from the volatility of reinvestment rates. Interest rate swaps. These can be used to exchange floating interest rates for fixed ones, shielding your investments from unexpected interest fluctuations. Think of it like trading the unknown for the predictable, keeping your returns steady on a bumpy road. Callable bonds analysis. Stay vigilant with callable bonds, as they may be redeemed early if interest rates drop. Ensure the yield compensates for this risk or seek bonds less likely to be called. Instruments can act like a Swiss Army knife for your portfolio. Each tool has a specific job, allowing you to navigate different market conditions without being caught off guard. Using these strategies wisely, you build resilience into your portfolio, ensuring a more stable journey through the shifting sands of investment choices. Case studies. Reinvestment risk in practice. Reinvestment risk can feel like a shadow that keeps investors on their toes. It's like playing a game of strategy where every move counts, and making the right call is essential. Understanding how this risk plays out in real-world scenarios can offer valuable insights. Let's dive into 2 case studies that highlight reinvestment risk in corporate and municipal bonds. Case Study 1. Corporate bonds. Imagine a pharmaceutical company issuing corporate bonds with a 5% interest rate. Investors buy these bonds, betting on the steady returns. However, a sudden economic shift prompts a central bank to cut interest rates to 2%. These bonds mature, leaving investors with a predicament: reinvest in a market offering half the returns. For our bondholders, this drop dramatically changes the landscape. Their predictable stream of cash becomes a trickle, forcing a hunt for better yields. They might look to longer maturity bonds or higher risk investments to maintain their income level. But with higher risks come increased chances of defaults, making their choice a real balancing act. It's a bit like switching from a slow-moving river to a whitewater rapid without a paddle. There's uncertainty and risk around each corner. This scenario underscores why understanding reinvestment risk ahead of time is a must for every investor navigating the financial waters. Case Study 2. Municipal bonds. Consider a small town issuing 10-year municipal bonds to fund a new infrastructure project. These bonds were attractive, coming with a juicy 6% coupon rate. Everything seemed perfect until the decade passed, and investors had to reinvest at the prevailing rate of only 3%. Now, these investors face a dilemma similar to corporate bondholders. The town's economic conditions and lower rates mean their stable source of income has halved. They may seek other municipal bonds or even explore corporate bonds, though each choice carries its unique risks. Investing in municipal bonds has always been a way to support local development while getting tax benefits. However, when reinvestment risk bites, it might feel like supporting the community comes at a personal cost. Like trading a luxury cruise for a rowboat, it's not the comfortable ride they signed up for. Both cases vividly show reinvestment risk isn't an abstract concept. It means staying adaptive and informed so when tides change, your investment strategy doesn't capsize. Understanding these scenarios helps in crafting plans that protect returns, regardless of shifts in the financial currents. Conclusion and key takeaways. Reinvestment risk might sound like a financial term you can gloss over, but its impact on your investments is anything but minor. As we've explored the ins and outs of this topic, the pressing reality is that it can affect your returns and long-term financial health. Whether you deal with bonds or other fixed income securities, reigniting your strategies with an understanding of reinvestment risk can make all the difference. Summing up reinvestment risk. So, what's the bottom line? At its core, reinvestment risk is about finding the same level of returns when it's time to reinvest your earnings. It's like trying to replace an old favorite pair of shoes with something just as comfortable and stylish, not always easy, right? It's a big deal. Reinvestment risk isn't just for the finance whizzes. It affects anyone who wants to make the most of their investments, especially in unpredictable markets. Types and traps. You've got interest rate, default, and call risks to consider. Each has its own twists and can catch you off guard if you're not prepared. Factors at play. Economic conditions and interest rates are 2 big ones. Keep an eye on these, and you'll be in a better position to adapt when things shift. Measuring the unseeable. Using tools like duration, convexity, and sensitivity analysis helps quantify what's often an abstract risk. Safety in numbers. Diversify your portfolio and use financial instruments like bond ladders to spread risk and cushion potential losses. Navigating the investment maze. Why bother with all this? Because reinvestment risk is like the weather, always changing. Consider these points as your umbrella, shielding you from potential financial storms. Stay alert. Regularly checking interest rates and economic trends can help you anticipate changes before they affect your portfolio. Adapt and diversify. Use an array of investments to spread risk. The broader your spread, the less impact one change will have on the whole. Strategize like a pro. Employ financial instruments to hedge against reinvestment risks and keep your investment journey smooth. Are you ready to tackle reinvestment risk head-on? Armed with the right knowledge and tools, you can navigate the financial seas with confidence. You're not just reacting to changes, you're prepared for them. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.